Welcome to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to formulate a view on where the market could be heading. And there's a lot going on in the markets right now. So we had a lot of seemingly positive tailwinds last week, but we couldn't get the market moving. And in fact, the S&P 500 is losing key support that we'll talk about here in just a second. But the one key catalyst we had last week was a stellar earnings report from the bellwether behind the AI trade, and that's with NVIDIA. NVIDIA easily surpassed analyst expectations when it reported earnings per share of $1.30 for the most recent quarter. For the third quarter, that's up 67% year over year. So a company that size growing earnings by 67% year over year is just incredible. It had revenues of $57 billion. They blew past estimates for the current quarter, so NVIDIA is forecasting fourth quarter revenue to come in at $65 billion. That compares to current estimates, or at the time that the earnings came out, of $61.6 billion. And so you had an initial jump in the stock. So a jump in NVIDIA helped spark a rally across the market last week following their earnings report. But that move was quickly reversed, and it's because investors are having to contend with a shifting outlook for rate cuts by the Federal Reserve. So you can see that in a couple weeks prior, the S&P 500 finally lost support at the 50-day moving average. That's the blue line. You can see we have not traded closed below, I should say, the 50-day moving average since the very start of May. Lost the 50-day. This big bar here, this big jump higher and subsequent reversal, that was the day NVIDIA reported earnings. We saw a mid-morning reversal where the S&P tried to move above the 50-day moving average but got rejected lower. And again, this is really interesting because the 50-day now is emerging as a battleground level on the other sides, where it served as support for quite a stretch. It's now serving as resistance. Early in the week, we're seeing the market test the 50-day from below once again. Something else to keep an eye on is that as we've had a fairly modest pullback in the S&P 500, so from the late October peak to the lows seen last week, the S&P was down about 5%. It's worth remembering that the S&P experiences at least, on average, about 5% pullbacks every year. So not uncommon to see this. But the thing to watch is that this RSI, the Relative Strength Index that measures price momentum, it got down to the lowest level since early April, since you're at the depths of the trade war. So approaching an oversold condition on the index, that'll be a key thing to watch on the S&P 500 here in the week ahead. So that's what's happening at the index level. Now, if we look at some other themes happening in the market, there's definitely this AI bubble theme. So NVIDIA's CEO, Jensen Huang, on their call, rejected the idea of an AI bubble. But again, we'll look at some evidence that valuations are running at historic levels. And so the reason why that's a risk is because we continue to have high inflation, and there's signs that the economy isn't deteriorating like many economists were fearing. And so that's creating uncertainty for additional rate cuts. We had some more evidence that the economy is doing fine last week. The delayed September payrolls report. Now, I know we're talking about September in this case, that report delayed because of the government shutdown, but it did show that there were 119,000 jobs added during the month. That was higher than expected. So we're seeing more and more data coming in as we're getting it, showing the economy is holding up just fine. And we're seeing, there's some conflicting messages coming out of the Fed as well. So the minutes of the Fed's most recent rate-setting meeting, it includes specific language that said many participants suggested it would be appropriate to keep the target range for the Fed funds rate, so the target range, unchanged for the rest of the year, implying no cut during December. So, but while we've got excessive valuations, and now there's this interest rate uncertainty that's clouding the outlook a little bit, it's worth remembering that stock prices follow earnings over the long run. So over the near term, we have a lot of noise, a lot of ups and downs in stock prices. When you zoom out and look at the longer term trends, it depends on where earnings are going. And so this is where signs of a growing economy are positive. Now, one other thing that could be a positive as we look into year-end, conditions across breadth and sentiment are favoring a rally. So we've got sentiment's been pretty negative. Breadth is starting to get oversold, and that is happening at a time when seasonality really this week in particular, seasonality starts to turn into a big tailwind during this holiday shortened week. And we're seeing some signs last week that buying pressure is rising. So this week, I want to take one more look at another look at historically elevated valuations, why that's leaving stock prices exposed to the rate outlook. But we also want to not forget the corporate earnings variable behind stock prices and I want to get a little bit more into why conditions favor that rally in the S&P 500 into year end. So while Nvidia's blowout earnings report and their forecasts show demand for AI applications remains very, very strong, stock prices across the market have been rising quicker than profits. And so the result of that is it's pushing valuations to record levels. The S&P 500 for PE ratio currently trades at 22.9 times. That is 34% above the 30-year average. It has only been higher during the internet bubble. Other valuation measures are pushing toward record highs as well. And that's leading to this composite valuation indicator that you see on here to hit levels we've never seen before. So what this does is it takes the trailing PE, forward PE ratio, cyclically adjusted price to earnings, price to book, price to sales, EV/EBITDA, and a couple other valuation ratios, and averages where they are in their percentile rank. And this goes back, I mean, look at this. This goes back to the early 1900s. And right now, I mean, look at that, the line right now is higher than it has ever been, all right? Easily surpassing where we were during the internet bubble in the late 1990s, even higher than the peak in 1929. So this elevated levels of valuations is what's making stock prices so sensitive to the rate outlook. So elevated valuations, again, makes stock prices sensitive to the rate outlook because this is impacting borrowing costs and the mechanism. Interest rates are the mechanism for discounting future expected earnings back to the present value terms. Now, concerns over the pace, magnitude of Fed rate cuts, that is weighing on stock prices over the past month, especially since the end of October. But ultimately, we have to remember that the S&P 500 is going to follow corporate earnings over the long term, and the corporate earnings comes down to the performance of the economy. And evidence continues pointing to an economy that's holding up just fine. So we've had, that delayed September payrolls report showing strong jobs growth, real-time estimates of retail sales. If you look at the Johnson Red Book retail sales, it's near the highest levels of the past 3 years. And now there's reports and data missing from this estimate, but this is the Atlanta Fed's GDP Now estimate, and it is currently forecasting third quarter annualized GDP growth at 4.2%. So the Atlanta Fed's estimate is this green line on here. You can see where economist forecasts are running. And this GDP Now estimate has been a pretty accurate predictor of GDP growth when you go and look back. So the fact that this is running at a over 4% annualized level shows you just how strong the economy is right now. If you were to break down deconstruct the components going into this, the consumer spending component is a major contributor. Concerns over the rate outlook, again, this is weighing on the S&P 500. The index is down as much as 5% off the late October peak. And the reality is that the action under the stock market's hood has been much worse. At one point last week, I shared the percent of stocks across the market trading above their 20-day moving average. So a way to measure short-term trends, a percent of stocks across the market trading in a short-term uptrend hit just 25%. That is among the lowest levels we have seen this year. And so you could say that's starting to approach oversold territory. Now, other breadth metrics are hitting oversold levels as well. That includes the NYSE McClellan oscillator that is showing on here. And what this does is it takes and measures advancing versus declining stocks on the NYSE over a trailing period and turns it into the oscillator that you see on this chart. And you can see last week we are hitting one of the lowest levels seen over the past year. So this takes us back 1 year historically. And again, you can see, here's the depths of the trade war sell-off. There's only been, since the trade war sell-off, there's only been 2 other times where we've seen the oscillator reaching this level. So we're starting to see this oversold condition emerging across the market. And at the same time, as conditions across breadth and sentiment are evolving favorably for a rally in the year end, we are starting to see some buying pressure emerge, which is really interesting because we're also at the same time we're entering this period of strong seasonality that starts just before Thanksgiving in the U.S. and it runs through the first couple days of the new year. And so, are we seeing the pullback in the market go a little too far? And are we starting to see the buyers start to emerge? Well, that's what this chart on here shows, that on Friday we were maybe starting to see, especially on the institutional side, buyers coming back into the market. So what this chart does is it looks at the S&P 500 index, is the blue line on here. But what I want you to pay attention to is the AD ratio. So this is the NYSE advanced decline ratio. So for any given day, what these bars are plotting is the ratio of advancing stocks to declining stocks. So if the number's over 1, it means you have more advancers than decliners. And on Friday last week, this ratio hit 6-to-1. So we had 6 advancing stocks for every declining stock. You can see that's the highest level since August. And looking back, that's one of the highest levels on the year. And why this is significant is usually to get such a strong ratio, to get a strong ratio usually indicates involvement of institutional investors. So the big money flow that you need to help drive a trend in the stock market. So if we're going to see the market stabilize here over the near term and start to turn higher during this favorable period of seasonality, you want to see those institutional investors getting involved, and that's what this ratio is indicating. Right. So at a time when we're starting to see, maybe see institutional investors getting more involved, it's worth noting that positioning across the market. So if you look at how investors are positioning their portfolios, the collective weight of the evidence shows that they are now back to an underweight position in equity exposure. And so this chart comes from Deutsche Bank. They take consolidated equity positioning, so they have a number of positioning indicators that goes into this blue line on here. And what that blue line is the weighted average Z-score. So the way to read this is 0 would be average. So this is the average equity exposure. Above 0 means investors are overweight equities. Below 0 means they're underweight. Get stretched out more far above or below 0. It indicates a more extreme overweight or underweight position. And this isn't a huge underweight to equities right now, but I think it is important to note that investors are starting to become underweight. That it's only taken a modest 5% pullback in the S&P 500 to see investors now underweight equity exposure. That echoes some of the other more bearish investor sentiment surveys that we're seeing out there. This is the lowest exposure since about the early part or so of summer. So, and this can be, it's definitely not a headwind to the markets. This could be another slight tailwind to the markets as we enter a strong seasonal period for the equity markets. All right, a number of key economic data releases to watch for this week. Now, some of these are old reports that should be getting released as a result of the government shutdown, but it's really unclear as to what is going to actually be released this week or not. So, I think this GDP report's already been delayed. The core PCE inflation report's potentially already delayed. So, we're going to take data as we can get it. Hopefully we can get a look at things like retail sales and PPI, the producer inflation report, ahead of the Fed's next meeting during the start of December. But so just keep an eye on this. This is a holiday shortened week. Volumes tend to be lighter, and so you can see these economic reports cause a little bit more volatility, but at this point it's still unclear as to what we are going to be seeing this week on the data front. All right, one chart I want you to keep an eye on is with GE Vernova, ticker GEV. This is one stock in particular that is going to be exposed to the demand for energy from the AI data center build out. And what I like about this chart is we've been in this extended consolidation pattern, this extended trading range really since July. So a fairly lengthy consolidation that's taking place after the stock touched near the 680 level and peaked out back in the middle of July. What we want to see is price now come back toward resistance at that level, and I would like to see one smaller pullback off of that before getting another breakout to new highs. But this is another Think of it as a pick and shovels trade, as it tends to benefit from the spending that's flowing through from the AI trade, namely the data center build out and demand for energy. That is all for this week.